Welcome to this epic explainer. Picture this for a second. It's a dark, rainy night. The lights in our protagonist Kabir's factory are flickering, and the machines are running painfully slow. This is the story of Kabir, an entrepreneur who literally had it all. Machines, a booming factory, big dreams. But suddenly, he notices something terrifying. His beloved business assets are losing their power. Market demand is tanking, his machines are totally outdated, and his competitors have rapidly upgraded their tech. The actual real-world value of his empire is falling off a cliff.
Kabir is just staring at his financial statements in absolute shock. He's tense, looking at his accounts and thinking, but wait, in my books, everything is at the exact same value. So what is the actual truth? He's slowly realizing that the static book values of his machines are just an illusion. It's a dangerous mirage masking a much harsher economic reality.
Section 1. Enter the ICAI mentor, breaking the illusion.
Just as despair sets in, boom! In a flash of brilliant white light, a calm, powerful figure appears. It's the ICAI mentor, and the mentor drops the golden rule of AS-28 on Kabir. Impairment happens when the carrying amount of an asset, so the value recorded in your books, exceeds its actual recoverable amount. Basically, whenever an overvalued asset's book amount is greater than what it can actually recover out there in the real world, it's impaired and you have to reduce it. Simply put, forcing an overvalued asset down to reality, that's impairment. Section 2. The trigger. Indicators of impairment. So how do you even know when to apply this rule? Well, first, we look outside the factory. External attacks can drastically drain an asset's true value without you even laying a finger on it. We're talking about a massive, unexpected decline in market value, or sudden adverse changes in technology, the economy, or the law. Even soaring market interest rates, or a crazy scenario where the company's net asset carrying amount completely exceeds its total market capitalization. These are giant, flashing red external warning signals. But then, the mentor points to the internal threats. These are the dangers lurking right inside Kabir's own factory. Things like obvious physical damage to the machines, or clear evidence that they're totally obsolete. It could also be management's plans to restructure or shut down operations early, or maybe internal reports clearly show that the economic performance of an asset is just terrible compared to what was budgeted. Whenever these signals pop up, Kabir has no choice but to run the impairment test. Section 3. The calculation zone, discovering true power. With the alarms blaring, the mentor pulls Kabir into a dark room filled with glowing, floating numbers. To find the actual recoverable amount, Kabir has to pit two crucial numbers against each other. On one side, we have the net selling price. That's the amount he could get from selling the asset in an arm's-length transaction minus the cost of disposal. On the other side, we have value in use. This represents the present, discounted value of all future cash flows expected from just continuously using the asset. It's essentially a battle. Selling it right now versus holding on and using it for the future. And the rule here is actually pretty straightforward. The true recoverable amount is simply whichever of these two values, net selling price or value in use, emerges victorious as the highest number. You literally just take the higher of the two and boom, that locks in your ultimate recoverable amount. Section 4. The big reveal. Kabir's machine. Let's see this in action. Kabir applies this technique to his main factory machine. Right now, his machine is sitting comfortably on the books with a carrying amount of 10 lakh rupees. But wait a minute, the net selling price is only 7 lakhs, and the value in use is projected at 8 lakhs. Since the value in use of 8 lakhs beats the selling price of 7 lakhs, his true recoverable amount is officially locked in at 8 lakh rupees. The aura of the machine fades, it cracks, and the painful truth is revealed. His carrying amount was 10 lakhs, but he can only recover 8 lakhs. That leaves Kabir with a massive impairment loss of exactly 2 lakh rupees. Kabir is stunned. He realizes he had drastically overvalued his empire, and he needs to make an immediate fix. He has to face reality and record this right now. He writes this 2 lakh rupee loss off immediately as an expense directly to the profit and loss account, while crediting the asset account to bring its carrying value down to earth. The illusion is officially broken. Moving on to Section 5. The plot twist, cash-generating units. Just when the calculations seem crystal clear, Kabir looks out at his sprawling factory and asks a totally valid question. Mentor, What if the value of an individual asset can't be measured on its own? Like, what if a single machine doesn't generate its own independent cash inflows? It's a great point. How can you possibly measure its value and use in total isolation if it completely depends on the rest of the assembly line?
To solve this, the mentor introduces the concept of the CGU, or cash generating unit. When individual measurement fails, Kabir has to group his assets together. A CGU is defined as the smallest identifiable group of assets that generates cash inflows largely independent of other assets. It's like treating the entire integrated production line, or maybe even the whole factory, as a single combined unit so you can successfully run that impairment test.
Let's look at an awesome real-world example from the standard. Imagine a bus company contracted by a municipality to run 5 separate routes. Now, even if one specific route operates at a massive loss, the company can't just shut it down because of their contract. Since they cannot be separated and they don't generate cash entirely on their own, all 5 routes together become the single cash-generating unit. They have to be evaluated as one connected group. Makes sense, right?
Section 6. The reversal arc. A glimmer of hope. Fast forward in our story, the dark economic clouds finally part, the market miraculously recovers, and Kabir notices the value of his factory beginning to glow brightly once again. He excitedly tells his mentor that his assets' values are going back up. The mentor smiles, but gives him a strict warning. Yes, an impairment loss can absolutely be reversed when economic conditions improve and your estimates change. And this reversal actually acts as income in the profit and loss statement. But there is a hard limit here to keep things grounded in reality. The asset's carrying amount can never, ever exceed what its original carrying amount would have been net of depreciation if no impairment had ever happened in the first place. Oh, and one quick extra rule. Impairment loss for goodwill, yeah, that's generally never reversed unless under super exceptional circumstances. So the asset regains its glow, but in a very controlled, realistic way.
Section 7. The final transformation. Exam power boost.
All right, Kabir has totally mastered the rules of AS-28. We've witnessed his final transformation from an illusioned business owner to a reality-focused, brilliant accountant. And now it's time to pass that power on to you. To secure your own victory, lock these 5 ultimate power boost points into your memory for your exams. 1. If carrying amount is greater than recoverable amount, you've got an impairment. 2. Recoverable amount is always the higher of net selling price and value in use. 3. The impairment loss is immediately charged to the P&L account. 4. You use a cash-generating unit when measuring an individual asset is impossible. And 5, reversible impairment is allowed, but strictly capped at the original carrying amount.
Our story concludes with this really profound realization from the mentor. Accounting is not just numbers. It is the courage to accept the truth. AS-28 is really all about having the bravery to strip away overvaluation, face your losses head-on, and align your books with actual, undeniable reality.